Happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here, as always, with the last week in Mortgage Today, where we take you through the week that was in the mortgage industry. And as always, each week, I try to pick somebody highly intelligent from our lender member network to be the co-host and back in the co-host seat for at least the third or fourth time on this show. One of our favorites, CEO, Megastar Financial, Anita Padilla. Anita, great to see you.
Thank you.
All right, let's go ahead and get into it. And as always, strive for interactivity with the show. Any questions, comments, thoughts anybody has for Anita or I, go ahead and put them in the chat, the Q&A, and we will incorporate it into the show unless it's just too dumb to incorporate. So let's go ahead and get into it. Anita, the Federal Reserve, what a dilemma they find themselves in. Some would argue self-inflicted wounds, a little late to the party. On the inflation game, the whole, inflation is transitory and then it's not, and the catch up. And here we are as they meet today, the first day of their 2-day most recent policy meeting. And Federal Reserve really tasked with a dilemma that they have on their hands. And that is wound, but don't cripple the U.S. economy, to try to rein in consumer spending, tampen a little bit a really hot labor market, and to help tamp down inflation without sending the U.S. and global economy into a massive recession. Got to be some sleepless nights for Jerome Powell these days.
Oh, absolutely. Really tough job at looking at the government and how they have reacted really since COVID. They went this way, now they're charged with going the other way. But, changes, I guess, that are probably necessary to achieve their goal, which really they're achieving their goal when we look at what's happening with inventory. So, your point about your earlier comments to us with regard to sellers not really having the upper hand anymore, right? And they kind of still do have the upper hand because we still have slightly higher demand than what we have with regard to inventory. But what the federal government is doing is working, raising rates and slowing down the affordability for customers to buy houses. Less people are qualified. So, it's a tough situation and interesting to watch. I look at what's going on, particularly with regard to volume. We all need volume right now, and we're having to right size. And, where do we go? How do we move forward? Where's our focus with regard to these higher rates? My loan officers will attend sales webinars, whatnot, and say to me, well, when we have this dip, I'm like, what dip? I don't know what dip we're looking for. Even if we have a slight dip with regard to rates, it's not going to be 2.5, 3 in the 3% range, the 4% range, where we did so much business and built our portfolios, which is really kind of our lifeblood right now, right? Is our servicing portfolios and the income we're getting on that strip. Other lenders who maybe didn't retain servicing, that's a tough story. So I'm just preparing for, I guess, what's the inevitable and how do we adjust to our new environment with regard to where the rates will be.
Outstanding perspective as always, Anita. Greatly appreciate it. And pleased to be joined by our other co-host this week. Wanted to get some insight just on the valuation side of what's going on in our industry. So we turn to our good friends and partners at Triserv Appraisal, longtime partners at TMC, top tier appraisal management company, doing business in all 50 states, and happy to welcome their Executive Vice President, National Director of Sales and Marketing, Ted Venhorst, to the show. Ted, great to see you.
Thank you, Rich. I appreciate it. Amy or Anita, nice to meet you. I'm sorry I had dialed into a different login, but it's nice to be here. Nice to join all of you. The good news on the appraisal side, of course, is that from the highs of the COVID, the past 2 years, we're seeing turn times drop dramatically. So when an appraisal is ordered, the turn times are very, very low. And that's in all 50 states. We're seeing that across the board, if you will. I'm even seeing appraisers call us now and ask if we have any orders. So in terms of values, other than some areas of the United States, values remain flat is what we're seeing. We're not really seeing values drop just yet, although I anticipate in certain markets we will see that. So happy to answer any other questions here, Rich, for you.
Absolutely. And thank you, Ted, for that perspective. And we'll certainly
Good.
be going back to you for more of it as we meander through the show. So Anita, let's go back to just the current climate and, just talking about, I guess, a lot of people are calling a reset in our industry. Let's take a look at where we're at right now. You have mortgage rates essentially doubled up 3.2 at the beginning of the year, but, in the mid sixes now. And, but now we're starting to see some of the things starting to happen that would portend a healthier market going forward. To Ted's point, values aren't dropping off the face of the planet, but they're starting to stabilize. We're seeing that month over month.
Right.
Increases are starting to diminish. Realtor.com did their big housing market report a couple of weeks ago. In that indicated that active listing inventory up 26% year over year. And the highest since October of 2020. But if you look, still nowhere near a healthy market. And I think the point you made was a salient one. Despite the fact we are seeing some moderation in values, we're seeing more listings hitting the market, we still have more demand than supply right now in the marketplace, correct? Anita?
Yeah. I mean, what I read is we do have a still slightly higher demand than what we have in inventory. When we look at the real estate available in the market, you have homes that are in a certain sector, and Ted, you could probably speak better to this than I can,
Sure.
where these houses are still selling relatively quickly. Then you have other homes that are, not in that sector, where sellers are looking for ways to move their inventory, move their property, and who they're going to sell to. One of the things that I find interesting is the iBuyers, I guess is what they're called, companies that are going in and making offers to these sellers, and the sellers potentially selling to these people. So what we look at is, okay, is that really in the best interest of the seller? And, what's their why? Do they need to move immediately? Or they're going to leave money on the table? With that same thought, you will see companies where they say, well, they actually got a better value with the iBuyer. So they're looking at pure data. So if there's something going on with the property that the data didn't show, maybe it had some sort of obsolescence, either interior or exterior, that caused the property to not value according to data. But for the most part, when you're in areas that are urban or rural, where you have a lot of a density, you are going to have more sales. And a lot of the times, assuming there's no obsolescence, the iBuyer is going to make a lower value offer than what a regular buyer would be willing to pay. But Ted, what are your thoughts?
Right. Well, one thing that I found still a little bit remarkable is that, and I saw this stat this morning, there's still 30% of the buyers are paying cash. And that's nationally. So that's still a very, very high percentage where people have already sold or, and taken the profits from their home. And, so that's still driving a large part of the market, and also where the values are remaining flat, if you will. You are not seeing any more appreciation. I haven't seen any at this time, but there's pockets, of course. Anybody can you tell what my background is? That's Phoenix. So anyway, Phoenix was one of the markets that was, the inflation is substantial. So We anticipate that the market in Phoenix will see a little bit of a drop, if you will. And of course, there's other areas in the country that will experience the same thing. But, certainly to your point, Anita, the iBuyers, people just have to sell and they just want to get out before. I think a lot of the thoughts and people selling right now is they want to sell before that dip, if you will. So kind of my 2 cents.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by the CEO of Megastar Financial, Anita Padilla, and the Executive Vice President and Director of National Sales and Marketing for Triserv Appraisal, longtime partner to TMC and beloved by the members, Ted Venhorst. So Ted, thanks for joining us and the partnership that Triserv and TMC have had for years. And you'll be in Chicago meeting with our members coming up here this week.
Absolutely. And I see we have almost 60 participants. If anybody will be in Chicago, I'd love to visit with you. I'd love to shake your hand. And if you have any specific questions about the appraisal process or how Triserv does things differently, I'd love to chat with you.
Awesome.
So thank you, Rich.
Over 400 registered and climbing. Should be a great event.
Yep.
Really
looking forward to it.
Absolutely. So Anita, FHA mortgage insurance premiums. I remember talking to you about this like 6 months ago, or whenever the last time you coasted was. And MBA recently, kind of put a paper out there. I think home buyers in this affordability climate need all the help on the margins they can. The FHA reserve fund 4.5 times where it should be. It's a lot of industry yammering for premiums that come down. Where do you sit on that?
Yeah, so I mean, the mathematics, I believe, presented do show that the amount of premium that's being collected today is more than what's needed, with regard to the delinquencies and foreclosures that are being experienced by HUD. Arguing, I guess, on the other side, that's largely due to values and values stable or increasing. So of course, if you have an asset that is worth more than the debt, you're going to liquidate the asset and pay off the debt. When the tables turn and you can't liquidate the asset to pay off the debt, that's when you start seeing the increase in foreclosures, whatnot. So I think it'll be interesting just to see how that really plays out, because, again, there's two sides of the coin. And, I think when President Trump took office, they were getting ready to lower values. We made all the changes, the paperwork was done, the computers were reprogrammed, and then boom, they pulled it. That was a major bummer. So, but ever since then, we've been doing well. And I think if they were going to decrease them way back then, I don't see any reason why they wouldn't do it today.
Mm-hmm.
Few industries that are affected more by the change in the White House and our industry. I remember when I was a leader in this industry and, talking to people like yourself, it's like, you think about what changes hands when the White House changes hands: FHFA, CFPB, HUD, FHA commissioner. And it's almost never, the same perspective that their predecessor has, but just another challenge, right? That leaders in our industry, another variable that is not controllable that you gotta react to and count for.
Mm-hmm. Mm-hmm.
Moving onward, Anita, in addition to owning Megastar Financial, you own a technology company. One of many reasons we love gleaning your perspective on the industry. And one of the deputies from FHFA spoke at a conference recently. And basically kind of went on talking about the risks that mortgage innovation pose, and kind of making the argument that, these risks are still unknown. They could be greater. They could diminish some of the efficiencies that new technology, purports to provide. Who better, I thought, than ask you in your perspective on this topic?
Thank you, Rich. And I obviously have a lot of thoughts on that. So, I think the government is, correct in asking people to think about the risks that would be posed with regard to all of these different, technologies. You go anywhere from the data warehouse, which is obviously mission critical in our world today with all the fraudsters out there, trying to ping our data, our ability to protect our consumers, and really the data, which is the lifeblood of your consumer base and how you do business. Also, when I think and I look at, we're getting bombarded with technology companies, pick me, pick me, pick me. One of the things I ask myself is, what experience does this company have in what I do for a living? Have they dealt with repurchase loans? Have they, did the, cost to produce, protection of my data? So, a lot of these very fine companies out there, introducing product is, what live experience, have you had with that? We don't want to be stuck with repurchase loans, et cetera. So I think that, when I ask myself, who's the fintech, what's their background, and what's their real life experience, and where does this fit into my stack? So at Megastar Financial, I work with retail relationship loan officers who have self-sourced business. So they're very entrepreneurial in that perspective. So is the tool that I'm asking them to use aligned with their business model? Or am I a company where the company's the brand? We're out doing the marketing, and the loan officer is really more of a licensed administrator. We pay loan officers a lot of money that are self-sourced because what we pay them for is bringing business in. So how do I provide them with technologies that they resonate with, that they're going to use? As an example, using some of the digital validations, right? What are you asking them to do? Are they going to accept it? So let's just say something as simple as form free, where you're validating bank assets. Well, the first question is your company aligned with SSV with Fannie Mae, so that you can get a day one certainty on the finding? If it's not, you're really just getting a bank statement versus 12 months of data that potentially could give you documentation relief and day one certainty. With the work number, the cost of the work number versus the cost of form free is substantial. So and if you're using the work number, are you using the benefit that comes with it, which again is the day one certainty? So because then you don't have to have an underwriter underwrite it. But if you're going down that same path with every loan anyway, your spend for the work number is pretty expensive. And if you're compiling that with a digital asset validation, you've just increased the expense. And if you're not using the day one certainty, really, is that a good use of your funds? So, that list can go on and on and on and on. So really, I think, you're to the government's point, number one, risk of your database. Number two, have you vetted to make sure you don't get stuck with any repurchase loans? Because that's a super big bummer, right? And what's your fintech stack cost? And are you going to be able to reasonably afford all of those technologies? And then I always ask, well, what about your employees? Somebody said to me with regard to our point of sale system, so are you like putting processors out of work or underwriters out of work because we have our augmented processor underwriter that does a lot of that work? I'm like, no, we're increasing the number of units that employee can do to make it more affordable for you and give you a compliant sellable loan. So, those are a few of my thoughts. I could, obviously go on forever, but as independent mortgage bankers, and we look at companies like Rocket Mortgage, they've done a great job. United Wholesale Mortgage has done a great job implementing digital validators to reduce their costs and expedite their ability to get loans done very quickly. And you compile that technology with loan officers that have built their business through relationships and being advocates for borrowers and families. And I think that the independent mortgage bankers can be very powerful with that combination.
I agree. And that was
Very good information. Yes.
incredibly well said, Anita.
Yeah.
Very poignant. And Ted, to you, the evaluation side of our business, technology, acceptance of it's come a long way.
It has, Rich, and
some of it by necessity, but some of it just by evolution. And your perspective on that side of the tech side of our business.
Absolutely. To piggyback on some of the things that yourself and Anita said, in terms of the validators, of course, there is the desktop remote valuation product that came out in January of this year. What we've found is that appraisers are reticent to embrace that because they are actually signing their name to a report where they have not seen the property, they have not been on site. So even though that product is available, and typically it can be a little quicker, but it hasn't been embraced by the appraisal community as much as we thought it would be. I think over time, that will become more and more a product that is being used. The other one is the ACE plus a PDR. So that is an automated collateral evaluation plus a property data report. And that became available effective July 17th. And I don't know if anyone on this call is taking advantage of that. Apparently, when a loan is submitted, Freddie Mac has a portal through the loan product advisor that gives you feedback as to whether the property is approved for this product. That is something, though, that we can offer. Both of those are something we can offer at Triserv. But in terms of the validators and the automation, it is starting to affect the appraisal process.
Thanks, Ted. This is the last week of Mortgage Today. We got about 5 minutes left with Anita Padilla of Megastar Financial, Ted Venhorst of Triserv Appraisal. Anita, you mentioned some of your larger, more notable competitors, Rocket Mortgage, United Wholesale, really have rode the pandemic wave to increased market share. Independent mortgage banks probably, I haven't seen the latest stats, doing close to 70% of the loans in America. I saw CFPB put a report out today, their latest HMDA data, the top 25 mortgage lenders in America. I think their market share went up by like 11% quarter over quarter. When the CFPB goes out of their way to put out a press release about that, it tells you, if you watch the breadcrumbs they're leaving, kind of what they're looking at, probably a little bit at least aware of the market share gains. And certainly some of the CEOs of those companies, do a good job staying in the papers. But Rocket and launched their inflation buster program. You see both of them kind of came out with their guesses on what the new conforming loan limits are going to be. And it harkens all back to something you said before we went live, and something that I've heard consistently from the smartest CEOs that I get a chance to speak with on a daily basis. And it's, if you're a lender, you really got to have what you called your secret sauce. You got to really have something that differentiates you, because in this day and age of, automated this and automated that, and apply on your phone, at the end of the day, it still is a human business, a massive purchase people are making. And I just see lenders this year, really that quest to differentiate themselves. And I'm certain that's part of the Megastar playbook as well. So.
Yeah, the hardest part, I think, is, when you look at Rocket, right, in this new product that they just came out with, their rate buster, they're doing a 1% buy down. And they're pricing it in. But what Rocket does, and they do well, is they don't pay loan officers for self-source business. They use those funds to advertise and to do the programs that they're doing today. And they've done a good job with their bucket, right? But our hopes is that they don't know how to expand their bucket. So their bucket is very digital. Then you look at self-source business in our bucket. Well, when you're dealing with entrepreneurs that self-source loan officers really are, call them what you are, they don't always want to take advantage of that digital platform. So, with the Loan Maps platform, you can approve the loan literally and have a certificate to deliver that loan into the secondary market if you follow what it tells you, if you use the digital platform. So Quicken does that. What falls out of their digital platform, though, can sometimes not be as smooth. United Wholesale Mortgage, brilliant, right? Brilliant. They go to their brokers and they kind of apply that same logic. They say, you will do it this way. And the brokers do it that way. And then they send it to United Wholesale Mortgage. Now, Rocket and United have huge servicing portfolios that are bringing cash in. They have public funding that they're using to subsidize rates. But at some point, they're going to have to turn the corner. And we all know that. But, in the interim, as independent mortgage bankers, let's focus on taking advantage of the digital platform and making sure your loan officers buy in, give them a reason, give them a discount on quality of delivery or your ability to get the loan approved at application, give them something to help them and do that so you can lower your cost to produce, deliver quickly, and know that you have a loan that you can securely, and I can only say that for Loan Maps, deliver into the secondary market. So, we need to compete with these people, and that's what it's going to, in my humble opinion, that's what it's going to take.
I love it. Very well said. Ted, no inflation buster appraisals you guys are offering at Triserv, right?
We got to keep that margin as best we can.
You have less appraisal.
Certainly, one of our requirements is that we pay customary and reasonable fees. So, we keep an eye on that all the time. But absolutely, our pricing is extremely fair.
Outstanding. Just about out of time for the week. Like to use this time to remind our listeners, the majority of you listen on podcast, which we love and appreciate. Join the live broadcast every Tuesday at 2 p.m. Eastern. Typically I have 50, 60, 70 people in here live. A lot of fun. Also can find our smiling faces on YouTube after the fact, Mortgage Collaborative's YouTube page, where you can find all of our previous episodes on demand. We've been doing this show every week, really since right after the pandemic started, and a therapeutic way, at least for me, to navigate what's been a wild 2.5 years for the mortgage industry since March of 2020. So I want to conclude by thanking our listeners for taking 30 minutes of your week out with us. The goal is to make this time effective for you. Listen as you're doing something else. Keep plugged into what's going on outside your silo. Want to thank Anita, Padilla Fitzgerald, the CEO of Megastar. Anita, thank you so much for all you do for the network and sharing your expertise with us.
Absolutely. Thank you for inviting me.
And to Ted Venhorst of Triserv Appraisal, longtime AMC partners at TMC. A lot of happy TMC lender member companies. You can find Ted at Chicago this weekend. Anybody on our team is going to be able to get you Ted's contact info at appraisal if you're looking for a great lead AMC that's doing business all over the country and doing a great job. But
Anita, nice to meet you. And Rich, thank you very much. It was a pleasure.
Yeah, and look forward to seeing everybody in Chicago.
Absolutely.
Chicago.
Thank you.
See you both there in the flesh, and many of you I saw in the live audience as well. So until next Tuesday, we're going to be in. It's going to 1 week a year. 2 weeks a year we don't do this during our live conferences. So we'll be back in 2 weeks. But a lot of you I'll get to see in person this weekend in the Windy City. Until then, have a great rest of the week, everybody.
Thank you. Have a good one. Thanks, everybody. Appreciate it.